And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, banking on local growth with Club Med South Africa to bring the first resort of its kind to the country. Good evening. Welcome to the program. 8 minutes after 6. I'm Stephen Grootes. A fascinating set of numbers today coming from various outlets about Discovery and the number of people who are on medical aid. And Discovery suggesting that the number of clients that they have has stayed roughly the same, roughly stable since 2019. But they do point to one category. It's sort of what you would call the top of the affordable category, if I can call it that. It's called Key Care Plus, and they say that since 2019 to 2024, that category has seen around 18% of its members disappear. And it does make me wonder, and I'm sure you've wondered about this, about the cost of medical aid. Now, this is a category that doesn't give you any sort of daily benefits. You're not going to get, a subscription or chronic or anything like that paid for. You're probably also not going to get minor injuries paid for. It really is, I presume, a kind of in case of emergency break glass kind of product. I'm not an expert on it. And it does make me wonder if we're at a point where if you do not see value for something, you just don't use it anymore. I mean, the same can happen with insurance. You can pay insurance premiums for 5 years and feel that you've got no value from it. And then, of course, something can happen on, year 6, and suddenly you really do get the full value from it. But it did just make me wonder how much you know about your medical aid. Whenever I talk to people about medical aid, and sometimes I must confess when I look at my own, I'm not entirely sure I understand it all. What I do know from my medical aid is that the people who've drawn it up know more about it than I do. That seems to suit them just fine. I'm sure you get the same feeling from time to time. So let me put the question to you like this. How do you feel right now about your medical aid? Has it saved your life, or perhaps the life of someone in your family? Or are you actually feeling quite, is it just a grudge purchase? Is it something you do because you have to? I know some people who have it for their children and not themselves just because it's so expensive. I know you'll have a view. 011 8830 702 021 446 0567, and of course voice notes this evening on 072 702 1702. We'll speak to Carel Vosloo in just a moment, the Chief Investment Officer at Remgro. They had pretty strong results. Also looking forward to another conversation around gold. I know you've had so many of them in recent times, but each time gold does something dramatic, and it does really look now like it's on track for $4,000 an ounce. The actual reasons for it are very, very interesting. And we'll speak to Manqoba Marinane about that. The World Trade Organization, in our view of it, Carol Payton, editor-at-large at Fin24, had an important story about that today, suggesting, in fact, our government has just been wrong on that. And then Coricraft has managed to bring some jobs back to South Africa. We keep hearing how difficult manufacturing is in South Africa, and some suggestions from them that with a little bit of help, actually they can bring jobs back. IT there on the WhatsApp line on 072 702 1702, just responding to that conversation around insurance, around what you do not get value from immediately, and medical aid, saying, I want to leave Santam because my insurance has gone up by 20%. It's very confusing. I do think that's one of the problems. You can read the document, try and spend time understanding it, and still come away a bit confused. How do you feel about your medical aid? I'd really like to know. Good evening. It's 12 after 6.
702. Stephen is on The Money Show.
6 to 8 p.m.
Well, fairly strong results out of Remgro today. Important contributions from Mediclinic, Outsurance and RCL Foods. That's Rainbow Chicken. Headline earnings up by nearly 40%. Remgro issuing a special dividend. That's after they sold their stake in British American Tobacco. Carel Vosloo is the Chief Investment Officer at Remgro. Carel, good evening and thanks for your time. Mediclinic was able to increase its contribution to your portfolio. Outsurance did well. Rainbow Chickens has improved since the bird flu epidemic. You must be pretty pleased with these businesses.
Hi, Stephen. Good evening. Yes, certainly a good set of results. I think compared to where we were last year, we will certainly take this as a good step in the right direction. And you mentioned lots of the highlights, but it was great to see positive earnings momentum really across the portfolio. I think we mentioned the number in the presentation this morning that more than 80% of the portfolio had improved earnings. So yeah, that's a good result for us.
Heineken's making a profit again, and from what I can see, they're reporting greater sales volumes. Do you still see growth in the beer market? I mean, there are some signs that younger people are drinking less beer or moving to alternatives. Of course, Heineken sell alcohol-free beer as well. Do you still see potential for growth there?
Yeah, there is still growth in the market, Stephen, and I do think one should distinguish, a market like our own from, very developed markets. So I think the dynamics are different. But no question, the beer market has growth in South Africa. It is a extremely competitive market, as are the other categories in the Heineken portfolio. But yeah, again, good strides in the right direction, and we hope that there's lots more to come from them.
One of the big selling points of your strategy, or one of the big points of your strategy over the last few years has basically been to make things a little simpler. Are you seeing the benefit of that now? Fewer stakes and fewer companies. Is that paying off for you?
I think that's an ongoing journey, but it certainly is part of the strategy for us to simplify what we have. I think there are probably 10 odd companies that account for close to 80% of the portfolio. So after that, there's a long tail of smaller businesses that, to be honest, don't quite move the needle enough. But the reality is that we need to spend the time and energy focusing on things that do move the needle. So it's an ongoing journey to simplify the portfolio. I think the bigger thing that has probably had an impact is a really intense focus and partnership with the management teams to drive the performance of those larger exposures in the portfolio, and that's turned out well this year. Again, the journey is not over, and there's lots still left to do. But as far as shortening the tail or simplifying the portfolio, there's some way to go on that. We've made some positive strides this year. But still a fair way to go.
So you're going to sell some of those smaller stakes then? You're going to continue that?
Yeah, I think we'll look for the right opportunity for each of them, and many of them are complicated and more difficult situations. So if you look at what we did this year, we about to unbundle our interest in eMedia. That was a little bit complicated, but still there was a route to a relatively simple capital markets exit. We disposed of some of our shares in FirstRand. We disposed of our BAT shares, but those are all capital market sort of exits. So those are relatively easy. Some of the other privately held companies and smaller companies, they require a bit more of a process. But there's some high quality companies amongst those. So it's just that it takes a bit of time.
There's still quite a big discount between the value of the stakes that you own in various companies and your share price. I think Fin24 put it quite nicely today. They said your intrinsic value is around 162 billion rand, but your value on the JSE at your sort of roughly the current share price is around 92 billion rand. I mean, I realize you're not the only organization on the JSE in this position, but that's a large discount.
It is a big discount, and we certainly are mindful that the part that we can control is the performance of the business, and that's part we can work hard at. Ultimately, the market will decide the price that they place on the shares. But I think it is important to recognise if there's a big divergence between our view of value and what the market's view of value is, that there's something to be done about that when we think hard about the reasons for that. And to be honest, I don't think we need to overcomplicate it. There are still big parts of our portfolio, and we can be specific. The likes of CIVH and Heineken are two big exposures that still don't contribute to headline earnings, and for different reasons. It's not that they both are underperforming. So it's different reasons for each of them. But I think in time, as the earnings come through, hopefully we can close that gap.
So, I mean, you're going to continue the current business strategy then, despite that discount. You're going to continue to try and create value for shareholders despite this discount when, and I'm sorry to put it so bluntly, shareholders don't necessarily see the value in the way that you do.
Yeah, no, we're absolutely committed to unlocking value and illustrating the value that we believe is there. The discount is maybe not quite as wide as you'd mentioned. I think we at the June year end it was around 45%. I think if we fast forward to today, the share price has been a little bit stronger, and I would guess that it's slightly below 40%. But even that is a wide margin, and we accept there will always be a discount. The investment holding companies typically trade at a discount, and one can probably expect that would be in the order of 20%. But so that means there's 20% at least for us to go after, and we've got every intent of proving that we can.
Carel Vosloo, I really appreciate the time. Thanks very much indeed. The Chief Investment Officer at Remgro, 18 minutes after 6.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, once again, another new record price for gold today, going past at $1,3780 an ounce. And you'll have heard me saying, and Mateo, quite boringly in business bulletin after business bulletin, how shares in our gold miners have shot up in the last year as gold has soared. The US President Donald Trump was speaking at the UN General Assembly today. I wouldn't be surprised if gold moves a little bit further, partly because of that. Manqoba Marinane is a strategist for fixed income, FX and commodities at RMB. Manqoba, good evening. Thanks for the time. The fundamental reasons for the rise in the gold price haven't changed in a while. Central banks have been buying as much gold as they can to bolster their reserves and protect their currencies. What's driving this shorter-term rise in the gold price in the last few weeks?
So I think the fundamentals actually, there's a bit of cloudiness, right? Because the core demand-like drivers have actually retreated. So what am I talking about there? There's investment flows. There is the physical market downstream requirements. There's the major central banks. So the central banks in Asia and Eastern Europe have continued to accumulate, but certainly not at the pace that we saw, say, earlier this year, right? So the demand side equation, actually, these elevated equations are levels actually are actually quite demand destructive. So major markets in India and China actually are reporting lower retail interest. So it's purely institutional flows, ETFs that are accumulating right now. So and it's important that we reference ETFs because they don't necessarily move with the tactical noises. So there's a secular force that's at play here, and it's a dollar weakness. It's a secular dollar weakness. Issue number one, it's a hedging interest against that weakness. But also I think a little known fact is that we are at the cusp of a Basel Committee review where gold could potentially be considered to be what they call a high quality liquid asset for the liquidity requirements for under the Basel III regulations. So this is a big shift. It's a secular shift. It's a long-term shift. It's not going to happen immediately. And my sense is that institutional investors are shifting capital with a long-term assessment that gold is in a structural shift in terms of its investment appeal. Saying that, we are sitting very surprised at where the price is right now. I think the last time we spoke, Steve, I gave you our year-end targets at about the 3,500 mark, so clearly well above that. So I think that shift is already underway.
I mean, it would surprise me almost if it's not $4,000 by the end of the week, never mind the end of the year, and that's an astonishing thing to say. How significant a factor is the dollar in this? Because for years, generations, the dollar has been the sort of bedrock of the global financial system. I know Russia and China would be absolutely allowed to have an argument about that, but it has been the reserve currency, the global reserve currency. Yeah. Everything is benchmarked in that. It's down, 10% on the year. The Trump administration wants to take it lower. Some of the noises coming out of the Trump administration are quite difficult. Facts don't seem to matter. Tylenol, etc. How big a factor is all of that in this?
Look, I think we have to classify this. The dollar will remain the reserve currency, right? Yes, it's down from northwards of 60% of reserves globally. It's now at about just over the 50% level. So just to contextualize this, I mean, gold is the second largest holding, and it sits under the 10% level. So there's quite a big gap. So we are still dealing with a long-term future where the dollar is still the basis reserve currency. But I think what is happening here is a portfolio diversification, a hedging, or in notional terms against dollar weakness. That is what is happening here. But underpinning that dollar weakness, and the recent catalyst of this big move higher was the Fed last week, right? Yes, they were slightly hawkish than we would have anticipated, but they guided that we're going to be cutting rates, and there's 2 more rate cuts ahead of us. And that's important because it on an opportunity cost viewpoint, holding a physical gold, all of a sudden we have clarity and confirmation from the Fed that opportunity cost is going to decline into year end. So therefore, it is a reason for those institutional funds to begin to raise their investment holdings in gold. And it's interesting, Steve, because when I look at ETF flows, right, we are still well off the COVID peaks in terms of the total holdings. So there's still quite a way up, left. So that's the big force that is at play at the moment.
I've been trying to look, is there any factor on the horizon that I can see that would weaken the gold price at the moment? And I'm no expert in it, you are, but I can't see one.
Look, I think there'll be intermittent episodes of weakness. Right now, I mean, the one thing that I always reference as a let's calm our heads kind of thing, the gold to copper ratio, right? Where it is right now, it's above where it was during the COVID years. So at its peak, so we've just climbed above that. So what is that saying to us? It's saying to us the gold market or gold prices being the safe haven asset relative to copper, which is a bellwether of the global economy. That ratio is basically saying that gold is almost pricing the global economic situation as if we are in a deep recession. My humble opinion is that I disagree with that. So I think that from a valuation perspective, we've gone a bit far. There's going to be a pure valuation-driven move lower until we see evidence that there is a shift. That big secular issue that I spoke about, gold being adopted as a level 1 HQLA asset for Basel III. Until we see that, then we will move higher. But for now, it's just largely a weaker USD issue.
Mankoba, thanks very much. Really appreciate it. Mankoba Madinane is a strategist for fixed income, FX and commodities at RMB. 26 minutes after 6.
The Money Show.
The markets.
Ryan Heels, head of fundamental sales at Absa CIB. Ryan, good evening. I mean, I don't know if you can see any factors that would bring gold down from this point.
Yeah, evening, Stephen. Clearly exercising the minds of many market participants. I tend to agree. I mean, we were running through a little analysis saying, if the Fed cuts rates, as your previous guest has said, that should be positive for gold prices because it reduces the cost of holding the physical metal. But if they raise rates because there is an inflationary environment that's boiling up, that should be positive for gold as well, because basically gold is considered to have inflationary hedge properties as well. So it is hard to see an environment where gold goes down at the moment. In fact, the one I would suggest that could potentially transpire is if we do see enough of a sort of crisis, whether it's geopolitical or potentially financial, maybe there's some sort of credit event that causes a flight for the hills, then what the market will tend to do is it'll tend to rush toward the largest pools of liquidity. In that environment, we might see gold sell off with many other assets, and we could see, for example, dollar strength emerge in that space. But I mean, that would be a fairly special kind of situation.
Yeah, it does seem unlikely, but I take your point. Platinum's going along with gold. It was up, what was it, 4% on the day, I think?
Yeah, I mean, platinum back at, 10-year highs. Again, it seems to me that there's an element of sort of precious metal contagion across both, gold and the PGM space, so platinum, palladium, all rallying today. Rhodium even actually came under a bit of a bid as well, now trading through $7,100. Look, I mean, historically, the platinum group metals have all been industrial metals. Their large application is essentially in the, back ends of cars. So you're trying to reduce emissions from vehicles, and you basically stick auto catalysts in there. And the platinum metals, of course, play a key role. Historically, while the industrial demand has, of course, dominated, there has been a push into platinum jewelry as well. We know the Chinese adopted platinum jewelry in quite a big way, but they've come off their peak, a couple of years ago. So the only thing I could find really is that there's one metal consultancy that is suggesting that the platinum and palladium markets are in much greater deficit than was initially expected. There is apparently some sort of supply disruption that seems to be playing out in the market at the moment. We know that there was some flooding at some of Valterra's mines, for example, and in fact one of the other PGM players also went through a stock counting process, which meant that they reduced the output from their precious metal smelters. So markets are basically quite tight physically, and there are some industry players suggesting that supply could be under further pressure. We think that we could see supply come down by about 1%, but I've seen estimates as high as 6%. So if supply does become a bit of a bottleneck, we could see markets tighten, and of course that will drive PGM prices up further.
And then luxury goods at the moment are quite interesting to watch for various reasons.
Yeah, it does seem as though there's an emerging consensus view that says that we're seeing stronger demand improvements in both soft and hard luxury. And of course, if that is the case, off a low base a year ago, we could see some support for earnings upgrades coming through. And of course, that'll then drive share prices north as well.
Ryan Hill, thanks very much indeed. Head of fundamental sales at Absa CIB. Well, while we've been having this gold conversation, a WhatsApp coming through on the line basically saying the dollar will remain the reserve currency as a loose statement. 100 years ago, the pound was the reserve currency. It lost that seat. There should perhaps be a big deep dive into why the dollar would remain the reserve currency before accepting that kind of comment. We'll keep them coming on 072 702 1702. Just gone 6:30.
WhatsApp Stephen
on 072
702
1702.
Two interesting WhatsApps coming through about medical aid. Tony says, Stephen, for medical aid, you need a Master of Science degree to understand how they operate. Margaret, completely different view. Last year, I was in hospital for 8 days. My appendix ruptured. I'm 77. Discovery paid for everything. That's actually from Stephanie in Kalani. So very interesting and contrasting reports about medical aid. 13 minutes to 7. An important piece in Fin24 today by Carel Payton, essentially claiming that our government is obstructing progress at the World Trade Organization. We're refusing to allow certain agreements to progress until the Doha round of trade talks is restarted. Carel Payton's an editor-at-large at Fin24 joins us now. Carel, good evening and thanks for the time. From what you say, we're being quite obstructive at the WTO. What have we been doing?
Good evening, Stephen. Well, I was quite astonished, I must say, because okay, the WTO is a little bit under the radar at the moment just because of all the Trump tariffs and all of that. But it is still a very important organization. And 72% of world trade is still going through, under WTO rules. And I was quite amazed to hear the DG of the WTO really berating South Africa for standing in the way of certain agreements. And, she was very upset because she said that, why are you blocking this? You, South Africa, in fact, she was referring to South Africa, Turkey, and India. why are you blocking these agreements which could be good for other people? And the one in particular she was talking about was an agreement in which member countries would establish a kind of set of, pointers really, or that developing countries could sign up to and do, which would make their investment environment, the environment for doing business, more attractive to outside investors. So this was something that the WTO thought, well, here we can help. We can help poorer countries get investment by all agreeing to these sort of coded measures. And, investors will be able to say, okay, well, that they've signed up for it. We feel good, we could invest. And South Africa has been one of the three countries, along with Turkey and India, who've been blocking this agreement from becoming part of the World Trade Organization rules, and they've kind of stood in the way of it for their own reasons. As you said, for a reason which, in my view and in many people's view, doesn't really hold any water anymore.
Well, I mean, it doesn't seem that there's a principle that's worth defending. I mean, you can try and defend the right of open access to telephone landlines, but when telephone landlines don't exist anymore, there's no point.
Well, this is the thing. So the Doha round, it was started in, I think, 2001. It was supposed to be a very progressive, pro-poor, pro-developing country round of negotiations. By 2008, it had collapsed. And since then, it hasn't gone anywhere. So it's quite bizarre for South Africa to say, we're not going to sign up to any agreement, no matter what it is, even if it really is, it's an agreement that really assists poorer countries. We're not going to sign up for that because we want to, the clock to turn back to 2008 when we were still doing the Doha round, and we want to do that. We want to carry on with that. When clearly the rest of the world, that is a non-starter. That's just not going to happen.
The other issue seems to be, as I understand it from what you wrote, our government's demand for a tariff or customs duty that would apply to digital goods. I've been scratching my head on that one, I have to say.
Yeah, so that's the second agreement. So the first one is about this easy investment kind of benchmarks. And the second one is about, it's an agreement on e-commerce and sort of setting rules for e-commerce. And part of this e-commerce agreement is that all member countries have, since 1998, all member countries have said, let's all agree we're not going to charge customs tariffs and duties on products that are digitally delivered. So this is not like something you order from Amazon, which is a physical thing. This is you buying your software from Microsoft, for instance. And they said, they're not going to impose tariffs on these things because it's kind of, it's very difficult to know how you do that. And so the agreement was, well, nobody does this, and then we're all, we'll take it from there. And they've been renewing this moratorium. So now the proposal is that this moratorium on imposing these tariffs be made permanent. Because it is so difficult, how do you, start charging people customs duties on their Netflix account, or charging Netflix? In fact, because it's not charging the consumer, you're charging Netflix. How do you do that? And it's not practical. So some other countries have said, well, let's just add some sales tax to that. So when you pay your Netflix subscription, they add sales tax, and then that portion goes off to the government. So the government isn't getting shortchanged here. So there are those sorts of solutions. But South Africa said, no, we're not going to, we want this moratorium gone. We believe we should be able to impose customs duties on all of these digitally delivered products. And this has now become a sticking point to the whole agreement on e-commerce.
Carel Payton, thank you very much indeed. Editor-at-large at Fin24. And she says, I, for the life of me, can't see how you would, impose some kind of tariff on the way in which I use a Microsoft product or whatever it is. I'm sure, like you probably use some kind of memory provided by Google or Apple or someone. How do you even start with a kind of tariff or any kind of customs thing on that? Some of this is a little complicated. And it does make me wonder if sometimes so many of our sort of government policies are just stuck in the mud a little bit and there seems to be no possibility of a change. 7 minutes to 7.
The Money Show, Stephen Grootes, is brought to you by Absa CIB, banking on local growth with Club Med South Africa to bring the first resort of its kind to the country.
5 minutes now to 7 the time. Well, one of the most interesting and I think difficult sectors in South Africa at the moment is manufacturing. Whenever I speak to people involved in manufacturing on the Money Show, and whenever I speak to people involved in manufacturing socially, they say the same thing. Making stuff in South Africa is hard. The issues around infrastructure, electricity, water, roads, a whole host of other issues. So I was interested in a statement from the Localisation Support Fund that they've been able to help the furniture maker Coricraft bring their production back home and support 500 jobs in the process. Irshaad Kathrada is the CEO of the Localisation Support Fund. Irshaad, good evening. So Coricraft was producing its goods outside the country. They brought that back home, that production. What support did they need to do that?
Good evening, Stephen, to you and your listeners, and thanks so much for having me on the show. So, look, Coricraft has been on a journey. It was bought by the Foschini Group a couple of years ago, and listeners may know that Foschini have had this strategy of trying to localize a lot more of their manufacturing. And it's a strategy that's not just built out of sort of goodwill to South Africa, but it makes real good commercial sense, because what they say is that by having their manufacturing closer to the consumer, they can be much more agile to customer needs. And so this has played out quite well for them in the clothing and textile space. And so buying into a furniture manufacturer like Coricraft, they wanted to see whether or not the same strategy could play out. So about a year ago, we sat with them really to kind of understand where they were going, what their needs were, where they saw the real opportunities. And they had highlighted for us that upholstered seating was a big one. Under the TFG brand, the Foschini Group brand, they own not only Coricraft, but also At Home, Volpes and Dial-A-Bed. And a lot of what was being sold in those stores were, as you say, coming in from abroad. But they saw an opportunity to localize and to create sort of branded items that really appealed to the consumer. And so we've walked this journey with them quite well over the last year. We paid for process and industrial engineers to go into factories to just start measuring what they were doing. And there's that old sort of adage that if you don't measure it, you can't manage it and you can't improve it. And it's really, I think that came to light quite significantly with Coricraft. And they've been able to localize around 80 million rand of production. These are 80 million rands of goods that were, supporting the economies of India and China and elsewhere. It's now in the local economy being produced in their factory in Epping and Cape Town.
So is this now sustainable? They don't need any more help from you or anyone else?
Yeah, so I think for Coricraft, certainly this is sustainable. I think the lessons that they've learned through this process, they've effectively banked, if you will, and they're now looking at other areas that they can go into. And so speaking to the head of business today on the panel when we released the report, they're looking at not only upholstered furniture, but some more of their leather seating, but also case goods as well. And they've mentioned that there's a number of other factories in the Foschini Furniture Group, so Volpes, which is down in PE, that they want to start introducing the same kind of measures too. And I think not only is this something that is replicatable within the Coricraft group, what was really great for us is that we brought a range of various furniture manufacturers into the room today. And a number of them walked away, as we said, that they walked away with learnings that they feel they can already start implementing before you bring in this type of industrial engineering support.
I think most South Africans want to buy goods that are made in South Africa. The problem is price. I mean, there's a reason why we end up buying so many goods from Asia. Is there anything that you can see that government could do to make a difference? Now, I'm not suggesting they should, support furniture prices, but it is surely about better infrastructure and better services to manufacturing companies.
So absolutely. Look, I think there is a role for government to play. And I think when you sketched out the intro to this conversation, you said manufacturing is difficult. And it is difficult. It requires huge investment upfront in human capital, working capital, physical machinery to manufacture, but it obviously does require streamlined services from government, both at a municipal level, but also at a national level in terms of logistics and port infrastructure and all the rest of it. So there's clearly a role for government, but it's not to say that the burden is only on government's hands. And I think the Localisation Support Fund was set up as an independent non-profit to try and drive home some of these efficiency and competitiveness strategies that can help to bring down price. And so if I take this Coricraft example as an illustration, they've been able to improve their efficiency by 38%. Now, what does that mean? It means that for the same assets, for the same investment in human capital and physical capital, they're getting 38% more out of it. And that's 38% more, which can be used to reduce the prices and to offer better value to their customers and to their consumers down the line. And that's how we stay competitive. It's not going to work in every industry, but there's a lot of industries where there's some very low-hanging fruit. We've done the same thing in the clothing space, working with retailers like Cape Union Mart. We've also done this in the chemical space, working with multinational FMCGs. So what we're trying to do is identify where we've got a willing partner, where there's a strategy around localization, where there's engagement, and to use that partnership then to drive home these interventions. And, bit by bit, we're starting to accrue the rewards and seeing the dividends through the economy.
Irshaad Kathrada, thank you, CEO of the Localisation Support Fund, just after 7 o'clock.
The Money Show
with Stephen Grootes.
The Green Economy on The Money Show is brought to you by the Rose Foundation, giving used oil a renewed purpose and supporting a clean environment one drop at a time. Well, last week you heard from one of the organisations that wants to drill for oil off our coast, Shell explaining their thinking about why they believe drilling for oil makes economic sense. But other groups, including the Green Connection, they believe plans by companies, including Total Energies, to drill off the coast of Saldanha in what they say would be the world's deepest offshore well, are just wrong. Jahil Singh is the legal advisor at the Green Connection. Jahil, good evening and thanks for the time. Why do you believe this drilling would be such a bad idea?
Hi, good evening. Thanks for having me. So, at the heart of it, our opposition is based on the law and what it says. So, with things like these, the Constitution is really the starting point, and that guarantees everyone the right to an environment that's not harmful to health or well-being. And it requires the government to protect natural resources for the benefit of present and future generations. And there's further legislation that gives life to this right, such as the National Environmental Management Act, which says that public participation must be promoted, and special consideration has to be given for disadvantaged and vulnerable groups, groups such as small-scale fishers and coastal communities. Really, it's about what the law says and what the law demands of companies and others who are proposing projects like this.
Okay, so Shahil, I argued with the oil company last week, so I'm going to argue with you too, okay? So if I were arguing for them, I would probably make this argument. Yes, government needs to follow the law, but government is also obligated to help grow the economy so that all South Africans can benefit, and all South Africans would benefit financially if they were able to drill for oil off our coast. There would be a huge amount of money coming into government and many more people would be employed.
So this is often the argument that's put forward, but in reality, that's really not the case. So if we look at, for example, this environmental impact assessment itself, it actually notes that most of the highly specialized work and equipment for this project would likely come from outside contractors and people from overseas. So this means that the number of local long-term jobs is extremely limited. By contrast, if there was a spill or an accident or something like that, the risks to our oceans, to our fishing communities, it could be astronomically dangerous. This is going to affect people who have been tied to the oceans for generations. So it's really not fair that South Africans should have to carry the risk, while most of the economic benefit actually goes elsewhere. So, from our perspective, we feel that the economic argument, it really doesn't hold water.
But Shahil, we would all benefit because there would be money coming in through tax, through the petroleum royalties. There are all sorts of ways to look at it. But money would certainly be coming into government that would have to come from other forms of tax if it didn't come from this. In other words, if there's a big oil find, the money that it generates would be taxed in the form of royalties, and that would benefit everybody, surely, would go the argument.
So, in theory, maybe, but we know that in reality, tax money is often spent inappropriately, and the people who would be put most at risk, they wouldn't have the biggest benefit, and it's their livelihoods that would be put at greatest risk. So it's simply unfair to them because they have no other way of making a living. They've been tied to this industry. It's all they know. So it's really unfair to put this kind of risk on them when they don't derive any of the direct benefits from it.
Okay, but you're taking a small group of people and saying this small group of people would be affected negatively, and as a result, the rest of the country should suffer the loss of the money that would come into government. I mean, that's what your argument is.
But it's not a small group of people. If there's some kind of spill, it would spill into the ocean, and that would affect South Africa as a whole. So it's really not a small group of people. It would affect all of us.
Well, it would affect all of us, and that we would all have more money, Shahil, would be the argument. Come on.
We may have more money. There's no guarantee of it, but it could cause irreparable environmental harm. And that's something that money simply can't reverse. And I mean, we can't go against our government's imperatives to take care of our environment. We can't disregard a spill, regardless of how big or small the chance is, if the effects could be as catastrophic as they could.
I wouldn't be surprised. I mean, I have no way of knowing. I haven't seen polling on this. Maybe you have at the Green Connection, Shahil. But if I had to ask now, every single South African, what's more important, protecting the environment or helping you to have more money in your pocket so that you can look after your children, I think I know which way they would go. And while I absolutely appreciate the importance of the environment, I don't think that's the way they would go.
Well, that's really simply a matter of debate because it's about how you phrase it and how you make them understand it. People often misunderstand things because they're not given all of the information, so that they can make a good decision about what's going on.
I don't think saying that people would vote the wrong way because they don't know enough is the answer, Shahil. I'm making the simple point that millions of people in South Africa need every help they can get, and maybe these oil companies would do that.
Well, in our previous court case, the courts actually ruled on the fact that in our TIPSA 567 matter, one of the points was that people weren't given all of the information about the project beforehand. And that's one of the reasons why the project couldn't happen. So, I mean, I've got to disagree with you there. I think if people are given most of the information, they would see in a different way and they would decide differently.
Shahil Singh, thanks very much indeed for the argument. I do appreciate it. Legal advisor at the Green Connection. You've heard both sides of this now. I'll be very interested in your view on this.
The Money Show.
The Africa Business Report.
Well, Dr. Rutendo Windingwi is the founding director at Tribe Africa Advisory and author of the book Rumble in the Jungle Reloaded. How's it, Rutendo? Thanks for coming in on a pre-Heritage Day money show. Google, they've been pushing beyond this $1 billion pledge for Africa. They've got some new big infrastructure hubs here.
Good evening to you, Stephen. And Heritage Day been appropriate since the Africa session, but that's indeed true. Since 2021, Google has been investing as the target to invest over $1 billion in terms of infrastructure. They see Africa as a place for opportunity, and specifically why the penetration rates, according to some research in terms of internet on the African continent, on average, Stephen, is about 57%, where the rest of the world is 17%. So technology is a key driver in terms of taking the continent forward. They've looking at investing in strategic data hubs or landing sites that then would tap into the rest of the internet and technology infrastructure on the continent. Two notable projects are Equiano and Umoja cables, which are expected to land on the coast of Africa by end of this year. Competing they are also competing with Microsoft that is making similar investments, Stephen, which is Microsoft is investing about $1 billion onto a geothermal power data center in Kenya. So from a Google perspective, definitely a significant investment in infrastructure, and they're seeing this has been driven just by what Africa has with regards to a young population, that thrives on innovation and that also is going to provide talent and capability going into the future, Stephen.
Yeah, I mean, you've just got to invest as much money as you can in the space, I would think. I mean, whether it's AI or not AI, to be or not to be, I mean, it is absolutely going to be the issue. One of the things that we know about people who are from our continent is that many people are displaced and they generate a huge amount of money.
Yeah, so, one of the downside or the challenges we have in Africa, we've had a lot of displacement of people because of wars or from a health perspective for one reason or the other. And one of the beneficiaries of these people has been that they've actually benefited significantly from the G7 countries, but with the pullback in terms of aid, I think I was looking at the number, Stephen, 44% of aid that was coming into Africa has gone down from the G7 countries. But on the upside, people are beginning to realize they have to actually fend for themselves and provide solutions. And the number of people that you're looking at in Africa that have been displaced is about $50 million, which is quite not 50 million US dollars.
50 million people.
50 million people. But that 50 million people that have been displaced have created an informal sector economy of about 56 million US dollars, Stephen. And why this has happened is that people are beginning to become a bit more self-sustainable from this perspective. Just giving you some examples, some of the fragile economies like Burkina Faso, Mali and Libya who've gone through a lot of worst scenarios have actually taken the step up and have relied on mobile connectivity in terms of transacting. Somalia, for example, 82% use mobile technology or mobile money as compared to 9% of the population that actually have banks. So in a certain way, we're using technology, the whole thing of leapfrogging. I think the only danger that's there for me, Stephen, is when I look at these stories, we can go to Kenya, for example, where Kakuma, a refugee camp, has evolved and they're using, again, banking mechanisms in terms of resolving issues. I think the challenge I have is that we can use technology to leapfrog over the problems, but if the infrastructure is not resolved, if the cause of what's causing the displacement of people is not solved, then we're kind of putting an artificial bandage on solving issues. So I think that's my concern. It's all good and well that we're leveraging off these situations. And also at a logistics perspective, Stephen, the USA, the United Nations have got very complex advanced logistics mechanisms in terms of getting food around. When they pull away, this infrastructure still stays and can actually be used in terms of developing economies. But there's a good and a bad side of it, and I think that's where the balance comes into a challenge, Stephen.
Yeah, it's all about disputes and politics and governance as well.
Yeah.
And Strive Masiwa, the richest man in Zimbabwe, he's investing money. Is this 5 AI factories? Is that the right phrase? 5
AI factories. So 5, to use the short name, but it's artificial intelligence, again, leveraging off the technology and infrastructure investment on the continent. The key countries that he's wanting to invest in, Stephen, are the big 4+1. So South Africa, Nigeria, Kenya, Egypt, and Morocco. He's struck a deal with NVIDIA, and they plan to spend $720 million with regards to investing in this space. And why this is important is that one of the big challenges in Africa, and I don't know if you know this, Stephen, if you look at we've got a lot of AI capability in Africa, a lot of AI talent that can be skilled up. The biggest challenge, though, that only 5% of AI talent has got access to infrastructure that allows them to scale. And if Africa is going to go to the next level, and I'll give you one example. You look at the SME sector, for example, 42% of Africa's GDP is in the informal market space. But if we don't have tools like AI to be allowing them to scale, to go to the next level, then we don't go forward. So this investment by Strive and Cassava Technologies is quite significant in terms of taking the continent forward and making a dramatic impact in terms of economic development and technological advancement.
And then Uganda is borrowing money to build a power line to South Sudan. That's an interesting project.
Yeah, and out of all the countries, you would have thought it's a big surprise that Uganda has actually got excess of electricity or a surplus of electricity. And this has come about because they invested last year in a huge electrical transmission line and infrastructure. It was the Chinese who came on board and did that. And this was quite key from the perspective that they've now got to a point they've got surplus electricity and they're investing in a power line all across to South Sudan, which needs it. The cost of this, Stephen, is about $358 million. So the positive sign is that It's going to be money that they're going to borrow from the Africa Development Bank and the Arab Bank, and it's going to contribute significantly just in terms of the resources needed from that perspective. This money that they're also borrowing, Stephen, is also going to be used for water access, and they're building a clean water infrastructure with the DRC. So for me, it's another good story, similar to the Zimbabwe story with Strive Masiyiwa, the billionaire, is Africans realizing problems, but also intentionally leveraging off solutions that they are looking at themselves in terms of building and obviously developing the region.
And then Botswana, glory in the men's 400-meter final at the Athletics World Cup.
Yeah, so two key highlights there. The first one being Colin Kebenchipi, I'm trying to pronounce that name right. A 21-year-old, he broke his country's record, but won the 400 meters race. He beat Trinidad and Tobago. So remember last year, the Olympics, we also celebrated Lebogo, who actually won, I think it was the 200-meter race. But again, Colin and Tobago participated in the 4x400 meter race, and they won that again at the athletics championships in Japan. So a big thing. The president, their president Duma, who's currently obviously the United Nations, there are other heads of state, has made I think the 29th of September a holiday. So that's quite an achievement and an important thing for the country. It's a small country going through a lot of challenges, but moving in the right direction. I think we need to celebrate with Botswana in terms of this achievement, because when you look at who they're competing against and the countries they compete against, it's a lot of talent. So quite an achievement.
We had to win one race. We had to win a whole World Cup to get a public holiday. Rotendo Ndingwi, the founding director of Tribe Africa Advisory, thanks very much indeed. You've got 10 seconds to shake Aubrey Masango's hand.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, as you know, is a certified financial planner at Galileo Capital, and it's a problem tonight that I think many people have. What do you do when the home that you've grown up in, your parents are still there, and actually financially it's not a good idea for them? It's very difficult. The memories are very close. Everyone wants their grandchildren to come and spend time in the house that you grew up in, all sorts of things. So how do you make this move is really the question tonight. And Warren, good evening. It's not an easy one, is it?
It's not at all, and it's one of those things where you're intertwining money, emotions, history, and maybe a little bit of loss of independence a lot of the time, and many people grapple with this. But both the adult children and the parents who know that there is a problem, know that they can't maintain the property they're in, but they find it even more difficult just to let go and move on.
Yeah, all right. Well, we'll take your questions for Warren on this on 011 883 0702 and 021 446 0567. Financially, why would you want to leave? Why would you want to move? I mean, what is the big driver that actually forces people into this kind of situation, into this decision?
Well, very often, you end up with a couple that, that live in a house that maybe has, 4 or 5 bedrooms. The size of the land and the house itself are far bigger than what they need now because their families are grown and moved out. And so they get stuck with a relatively expensive property, both in terms of, either property taxes or levies, and then the cost of maintaining a property. And if they're in most sort of big towns and cities around South Africa, usually there's a swimming pool involved, there's a garden and lots of walls and roof surfaces that need to be maintained. And, if people are elderly, firstly, they physically can't do it. And secondly, the costs of that are just too much to bear. And then what happens is you get, a big property that's not being maintained, and very quickly it starts to lose value because, if you don't maintain a house, it's a bit like, a ship at sea. It just degrades very quickly when you're not looking after it. And so financially it becomes a compounding problem where the value is just being destroyed and eroded at an increasing rate and no one to do anything about it.
And I mean, it's often the biggest asset that a couple will have. So it really does need to be looked after. This is not an asset that you can lose money on.
Yeah, and if you're the kind of unmaintained house in the suburb, when it does eventually come time to sell, the people that drive past look at it and they don't say, well, gee, there's so much potential. They go, well, this is a nightmare. I'm not going to pay market price for this. I'm going to pay below market. So now you've got, the costs that you've been carrying all this time, that have just gone, and over and above that, the capital value of the assets just degrading very quickly. And so you're right, Stephen. It's one of those things where, other than their retirement fund, it's probably their next big asset, and it's losing value at a rapid rate. And don't get me started on if they're in an area and a city that's not doing well as well. That just makes the whole problem a lot worse.
You don't have to remind us where you live, Warren. This is not just about money, though, and this is what makes this difficult. This is about emotion, and it's not just people clinging to the past. They're living in the place where they brought up their children, and that matters to everybody.
Yeah, and it's. I think it's something that financial people, often lose sight of. This life isn't lived on a spreadsheet and managed by a calculator. It's something that we live with our hearts and souls. And so, if you're the adult child and you're living far away, it can be very frustrating when you kind of talk to your parents to say, but it's so obvious. Look at the spreadsheet. Look at how much money you're spending. Can't you see? Are you not capable of doing a calculation? And actually, the person that's incapable of seeing is not the parent, but it's the adult child who can't see what's going on. Parents have put their heart and soul into that house, and they've raised their children and their families. And for them, the house carries so many, very good memories. And so it's very difficult for them to foresee a life away from that house. And then the other thing we need to bear in mind is when we get older, change gets harder. And some people grapple with change at any age. And if you're in your 60s, 70s, or 80s and you're faced with the prospect of having to move, it becomes almost terrifying. And so, we've got to understand that, the spreadsheet might say one thing, but the heart and the soul are saying completely different things. And so we've got to just be really careful around how you approach a conversation like this, because you could be approaching it in completely the wrong way, where you're having an analytical conversation and you need to have a completely emotional conversation with somebody.
You've got to sort of manage the tone of it. The financial considerations of downsizing, generally speaking, it's the right thing. And so you've got to sort of talk through the advantages of moving somewhere else.
Yeah, I think, if the financial pressure is building, then it might be the way out in terms of having a constructive conversation that suits everybody, where everybody sees and feels the benefits on kind of a positive footing. And so just, understanding that when you have a large property, it's always more expensive to maintain than a small property. And so just from a running cost point of view, you're going to benefit by being in a smaller place. If you add to that, that maybe your rates and taxes might be lower, and then the convenience of not having to maintain the property, where you might have to pay additional staff, for looking after the property because you can't. Those costs add up very quickly, and also, or I should say, cost savings, and also potentially things like insurance. You save a lot on insurance and those kinds of costs as well. And so understanding that if you're going to sell the property and it's still in good condition, and you're going to buy a smaller place, potentially in the similar area, you could end up, realizing a fair amount of capital. Just for argument's sake, you sell, a house for 6 million and you buy a smaller place for 3 million. That 3 million gap is now money that you can use to fund a better lifestyle. And that would be the beginning of a conversation to say, that 3 million, why don't we put that away for an investment where you can draw some of that on an annual basis to go and do more travel overseas, to go and visit the grandchildren, or, go to see family around the country, or just enjoy good holidays, now that you're not spending your weekends maintaining the house. And so, there are, important considerations if you want to sell the property. And often, if the house is big and you've got adult children, you might find that they want to take over the house to raise their children. And that could be a conversation to be had, where you say, well, okay, I'll sell it to you, and potentially we can do it in a transaction over time. And so, it stays in the family. The emotional side of this is not so tough for people to deal with. And maybe lastly, particularly in kind of in Joburg, I find, often there are lots of cottages on a property where you can build out a cottage, and maybe the older parents move into the cottage, the younger, the adult children move into the main house. And so, there's kind of an extended family living situation where everybody's benefiting financially, and the pressure is off on the older parents. So there are lots of financial approaches that you can make to this, other than just toughing it out or just selling without a lot of consultation.
This only works if everyone gets on, by the way, Warren. I mean, if they don't get on, that's not going to work. So, I mean, there is that. You can hear stories for some people trying to get the money to buy a house big enough for their family that they want to bring up, and it's quite difficult. And I was interested in your comment about you can do it over time because it's a financial transaction in your family. You kind of know where they live. There are all sorts of options you wouldn't have if you wanted to buy a house on your own. If you're buying it from someone in your family, there could be a lot more flexibility.
Absolutely. And I think it's, you've got to be careful just about the legal implications of this, because you don't want to get stung with, donations tax or something like that. But what you can do is you can agree a payment period over time. So, if I'm the elderly parent and I'm selling to you, Stephen, as the young adult, I could say to you, let's have a payment plan where you pay me out over a 5 or 10 year period, and in between that, I'm happy to move into another place, and so we go. And there's some processes to follow from a legal point of view, but those aren't difficult to deal with, and that could be good for everybody, where the older parents start getting some capital in that they can use to fund their lifestyle, and the younger adult gets a bit of breathing room to buy in. And certainly the situation here you have to be careful of is don't sell the house at a major discount, because SARS is going to catch onto that very quickly, where if the house is worth 10 million rand and it suddenly goes through the books at 6 million, that goes through the deeds office, that's not going to just disappear into the ether. That's going to be a real kind of a red flag. So don't do it at a discount. Go and get 2 or 3 estate agents to give you a valuation, and you come up with a defendable valuation, and then be generous on the payment terms and the time frames. That's not a difficult thing to deal with. So you can, when you've got a soft deal like that between family, as you say, as long as everybody's getting on, you can make those payment terms very generous.
I suppose the other thing you've got to really consider is health. And as you get older, the chances of being a bit frail, maybe needing a little bit of help living, actually, could be quite a big factor in all of this.
Yeah, so it's something that we don't really think about a lot. You'd kind of say, well, I'm happy to stay in my house, and hopefully it'll be the last house I ever stay in. But what happens if you can't stay in the house and you can't stay unaided, and maybe you need frail care? Now, the trick or the tricky part about frail care is a lot of the time you can't just pop into a frail care facility and say, well, here I am, please look after me. Often good frail care facilities have waiting lists. And, if there is a retirement village with frail care attached, they'll always give preference to the people who are in the retirement village first, before they'll take outsiders, from not within the retirement village. And sometimes they just won't do it at all. They'll just say, if you're not in the retirement village, we don't take you into frail care. And financially, there's reasons for that, because there might be some cross subsidization between the kind of houses in the retirement village and the facilities. So if you want to have protection against a shock where you can't get into frail care at the right time, and usually it's going to be an urgent situation, then moving into a retirement village on the front foot when you're in relatively good health, where you can move into a place that you choose, and at a time of your choosing, might be a much better process than having to kind of be forced into a facility that you didn't choose because you're now in almost a medical emergency situation. And unfortunately, that happens quite a bit, and so, one of the things I'd be saying is, make sure that you just take the health, into consideration over and above the financial decisions, because, this is, as we said, it's a multifaceted, complex situation.
Yeah, no, there's so much to it. All right, we're going to resume this conversation. Your questions as well for Warren Ingram on 011 8830 and 021 4460567. Henry's come in with a question this evening saying, hi, Stephen. Inflation seems to be lower than economists predicted. What does this mean for my money? It's such an interesting question. All right, Henry, we'll have an answer for that too in just a moment. 10 minutes now to 8 o'clock.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram is a registered certified financial planner at Galileo Capital. And Warren, just before the break, we had that question from Henry saying inflation is lower than what economists predicted. What does it mean for my money? And it takes us to the thorny issue of interest rates.
Yeah, you're 100% right, Stephen. I think, normally when inflation comes in below what sort of the consensus prediction was, they would talk about forecasts, but really it's a prediction. We would expect the Reserve Bank to look at that very positively and then cut the interest rate that they are charging the banks, so the repo rate, which means that for the rest of us that our interest on our home loans, etc., the prime rate will drop. And that would be the normal trend. And equally the other way around, if inflation is going up more quickly than everyone expected, then you might worry that the bank would raise interest rates. And where we are at the moment, is that interest rates have come down a little bit from their peak, and so I feel certainly that there's quite a lot of scope for the Reserve Bank to cut rates, but they haven't done it because they're working around on a sort of a narrower inflation target. So I think they're trying to drive inflation even lower, and so the fact that economists have forecast a lower inflation and it came in below that doesn't seem that exciting to the Reserve Bank. They want to drive inflation lower. And the kind of sledgehammer tool that they use to manage inflation is interest rates. It's not a very kind of fine instrument. It's a rather blunt instrument, but it's the only one they use. And so unfortunately for now, we're in an environment where interest rates are still quite high and inflation's quite low. So we're earning quite a lot of growth above inflation on cash, which is not a healthy situation for most people and certainly not for businesses and the like. But it's medicine that the Reserve Bank feels we need for now. But I would say to someone like Henry asking the question is, in the long term, if inflation continues going down, it means interest rates go down. And that means that we should see a benefit in rising share prices, possibly even property prices and the like. So it is generally good news when we see inflation coming below expectation, just not right now.
I mean, and I suppose the issue also is it's a long game. It may not be doing what you wanted to do right now, but it is a long game.
It is, and just understanding that lots of investors, very savvy investors in the bond market and people, operating in the stock market and the cash markets are all looking at this and all trying to forecast where things are going to go, and so they're not always going to respond to the news, and do things after the fact. Very often they will try and anticipate what's going on and then buy shares if they believe interest rates are coming down, and they might be disappointed then when interest rates don't come down. So for most private investors who are not in the business of day trading and trying to speculate on things, I would look at this and be very patient to kind of see where the trends are going. And if we see inflation going down gradually, month to month, quarter to quarter, in longer periods, then you can start to make a kind of more rational decisions. But trying to change your investment portfolio based on monthly or 3 monthly data, unfortunately, what you usually do is you end up setting yourself up to fail, because as we see in this instance, it was actually very good news that inflation came in below the forecast, but rates didn't change. And so if you had expected to make some nice profits on good news, you're going to be disappointed now. And that's the real danger, when your predictions might be right, but markets don't work in your favor.
So much to it. All right, let's just go back quickly to the sort of main conversation around helping your parents or elderly people in your family move out of their big house. There's a big issue around the speed at which you do it. This is not something you should rush. It's a conversation you should have over a couple of years, that you should manage, and that you should deal with quite sensitively.
Yeah, I think that's exactly right. If you're the adult child, just understand you actually don't have a clue as to what your parents are feeling in a situation like this. So the fact that you can see benefits and that you think it's obvious is only obvious to you. You can't live that life, and you don't know what they're going through. So rather go from the position of asking good questions about what's bothering you about this house? Are you finding it difficult? And how would life look if you didn't have to worry about maintaining the property, as much as you are, and if you had some extra money in the bank account every month, from a stress point of view, etc. And very often it's the fear of the unknown. It's people saying, well, I don't want to go and live in a tiny little box where my neighbors know what I'm doing every day. And so maybe arranging for them, and going along with them to go and visit potential, alternatives and looking at what's available and actually walking through them. Because once you start to see what your alternatives are, either they're as bad as you fear or they're not. And potentially you might start to get excited about, a better alternative where you don't have to worry about gardens, but maybe you live in a place with beautiful gardens that are maintained by someone else and you just pay a levy for that. And potentially you get decent walls where you don't have nosy neighbors. So I think a lot of the time it's just talking through the situation and showing people where they can go. Once you can visualize your alternatives and they're not as bad as you think, the acceptance of change becomes easier. And also laying that path over a period of months and years is a very good idea, so that you want your parents to make that change from the front foot, where they feel they're in control and that the control of their life hasn't been taken away from them by their adult children, because that's traumatic and it's probably something that a lot of them won't recover from. So you're trying to nudge them and help them and give them the capability to make the change, but don't force it on them unless you absolutely have to because there was a financial or medical emergency. So take your time, do it in a considered way, and do it physically. Show people show your parents what the alternatives are. And if you're the parent, get in the car and go and see what your options are. They're very often very nice places that you can stay in, that are not kind of quasi prisons.
Mm-hmm. You don't want them to control you at 18. They don't want you to control them at 80, I suppose would be the way to remember it. Warren Ingram, thank you so much. Co-founder of Galileo Capital. This will be podcast and could easily be valuable to you or someone in your family.